Welcome back to the deep dive. Today we are focusing on, well, the true language of business, financial statements. And if you're a learner, a manager, or really just anyone trying to get under the hood of a company, you need to know these are not just, boring compliance documents.
Not at all.
They're the single most important strategic tool a company has to communicate its health, to manage risk, and, maybe most importantly, to raise capital.
They absolutely are. When you look at the sources we have, the core message is that financial reporting is, at its heart, a trust-building exercise. And, the easiest way to think about this is with the mortgage analogy.
Oh, I love this parallel. It makes it so clear. When you as an individual want to buy a house, you go to a lender, and what's the first thing they ask for?
They want a complete picture of your financial life. They need your income history, your pay stubs, which is, it's just like a company's income statement.
Right.
They need a list of everything you own and everything you owe. That's your personal balance sheet. And they want to see the actual cash moving in and out, your bank statements. That's the cash flow data.
And they take all that data just to figure out one thing, risk. And if you're low risk, you get a better interest rate. Simple as that.
Exactly right. And that's a direct parallel to business. A business hands over its income statement, its balance sheet, and its statement of cash flows to an investor. The investor looks at all that to assess risk and, of course, potential return.
And if those statements look good, if they're transparent and healthy, the business gets the funding it needs on much better terms.
It's the absolute bedrock of strategic funding and market credibility.
So our mission for this deep dive is to define those three statements, sure, but really to go deeper and understand the unbreakable logic that connects them. We want to move past the numbers and get to the strategic story they tell.
Okay, let's start with the clean definitions, just a concise phrase for each one. First up, the balance sheet.
The balance sheet is simply what we own and what we owe. And the key thing to remember here is that it's a snapshot. Just a single point in time, like midnight on December 31st.
Then you have the income statement. That's how we performed. And unlike the balance sheet, this isn't a snapshot. It's a movie.
A movie that runs over a specific period, like a quarter or a whole year. It's all about profitability.
Yep. And finally, the statement of cash flows. This one is where we got cash and where we spent it.
The lifeblood report, it tracks the actual physical cash.
Exactly. Now, you mentioned that unbreakable logic, and that logic starts with the one foundational rule of accounting, the accounting equation.
Assets, liabilities, plus equity.
It always has to equal that. And this isn't just some rule for accountants. It's the strategic truth of the business.
And the reason it has to balance is actually pretty simple, right?
It is. It's because the right side of the equation, the liabilities and the owner's equity, well, that's where the money came from. Those are the sources of funding.
And the left side, the assets, that's how the money was used.
Precisely. Every single thing the company controls was bought with either debt, which is a liability, or with the owner's own money or profits, which is the equity.
Now, tied right into this is a concept our sources really stress, the separate entity concept. The business's finances have to be kept strictly separate from the owners. Why is that so fundamental?
Oh, it's way more than just being tidy. Strategically, this is what protects everybody. If you start mixing your personal finances with the business's, you risk a court piercing the corporate veil.
Meaning the owners could suddenly be on the hook personally for the company's debts.
And that's the risk you're trying to manage. That separation is absolutely key.
Okay, so because of this deep connection, we often call the balance sheet the mother statement.
Exactly. The other two statements are really just detailed explanations of what changed between two balance sheet snapshots. The income statement explains the change in the equity section.
Through profit or loss.
Through retained earnings, yeah. And the statement of cash flows just explains the change in one specific asset, cash. So without the balance sheet setting the start and end points, the other two reports are kind of floating in space. So let's take that structure and turn it into managerial strategy. If you just look at the right side of the balance sheet, liabilities versus equity, you're looking at a company's strategic choice. The big dilemma. How much debt do we take on?
So let's say management decides to be heavy on liabilities. What does that tell us strategically?
It means they're being aggressive, they're leveraged. And look, leverage can be fantastic. It can amplify your returns when times are good because the money you earn on the borrowed cash is more than the interest you pay.
Right.
But it dramatically increases your risk because those loan payments, they have to be made, even if you have a terrible quarter.
And on the other side, a company heavy on equity is safer.
Much safer. Way more stable. But, a manager running that kind of company might get dinged for being too cautious.
For missing opportunities.
Yeah, for leaving potential growth on the table by not using debt to expand or innovate. So that balance really tells you the company's appetite for risk.
Okay, let's flip over to the asset side. This is where the value is. But what actually counts as an asset? I mean, it's a pretty strict definition, right? It has to meet three criteria.
It does. It has to be owned or controlled by the company. It has to be the result of a past transaction. And this is the most important one, it must be expected to provide probable future economic benefit.
That first one, owned or controlled, that's where we get that really powerful idea of substance over form.
Mhm. Accounting tries to look past the legal paperwork, past who holds the title, to see what's actually happening economically.
Can you give us a good example of that where control is more important than legal ownership?
Sure. Think about a delivery truck. Let's say a company signs a really complex lease for that truck. It's for 95% of its useful life, and the payments basically cover the whole cost of the truck. Now, legally, they don't own it.
They don't hold the title.
Right. But they control 100% of the economic benefit from that truck. So the accounting rules say, nope, you have to put that truck on your balance sheet as an asset and the lease payments as a liability.
So if they didn't, they could essentially hide billions in assets and liabilities off the books, making their company look artificially clean.
Got it. It prevents that kind of strategic game playing. Now, this is where it gets really interesting, especially for understanding a company's real worth. The intangible omission. We all know the McDonald's brand, their systems, their secret sauce. That's worth tens of billions. So why isn't it on the balance sheet?
It must fail one of the tests. It goes back to that third criterion, right? The reliably measurable part of future benefit.
Exactly that, and the principle of conservatism. If you spend, say, $10 million internally to develop an amazing training program for your employees, that money's just an expense on the income statement. It's gone because the future benefit is just too uncertain. Will the employees stay? Will the training actually boost sales? You can't reliably measure it, so you can't capitalize it as an asset.
But if you spend that same $10 million to buy a software patent from another company, that goes straight onto the balance sheet as an asset.
That's the key distinction. An external transaction, like buying a patent, it gives you an objective, measurable cost for a benefit you now control. And the lesson here for manager is huge. The balance sheet is conservative by design. It often massively understates a company's true economic value because its most valuable assets, brand, culture, people are just too uncertain to put on the books.
Let's pivot now to the performance reports, starting with the income statement, our movie of profitability. We know the basic equation. Revenues minus expenses is net income. But the timing of when you record that revenue is everything.
Oh, absolutely. We use what's called the revenue recognition principle. Revenue gets recognized when the performance obligation is satisfied. So you've delivered the product or service, and you're reasonably sure you're going to get paid.
And the key is that this can happen way before the cash actually hits your bank account.
Right. So think of a software company that sells a one-year subscription today for $1,200 paid up front. They have the cash, but they can't record $1,200 in revenue today.
Because they haven't delivered the service for the whole year yet?
Exactly. They've only earned 1/12 of it this month. And this timing mismatch is why the income statement, while great for profitability, can be a terrible measure of liquidity. And that's why the statement of cash flows is just so indispensable.
And one quick point on the income statement before we move on. Dividends. We should remind everyone that expenses are costs you incur to generate revenue. Dividends are different.
A very crucial distinction. Dividends are a distribution of profit after it's been earned. They are not an expense, and they're not on the income statement.
Okay, so that brings us to the lifeblood report, the statement of cash flows. It tracks where cash came from and where it went across three areas: operations, investing, and financing.
And like you said before, a company can look amazingly profitable on paper but still go bankrupt because it just runs out of cash.
So let's use the McDonald's 2012 figures to bring all three of these statements together. They reported a very healthy net income of $5.5 billion.
Right, so the income statement tells us this is a highly profitable business, their core model works, but the cash flow statement, that tells the deeper story. It shows they actually generated $7.0 billion from operations.
Okay, hang on. Their profit, their net income, was $5.5 billion, but their cash from operations was $7 billion. How can the cash be so much higher than the profit? This is where I think a lot of people get tripped up.
This is probably the most important analytical question you can ask.
Yeah.
That $1.5 billion difference is mostly due to non-cash charges. The big one is depreciation. Depreciation is an expense on the income statement, so it reduces your net income, but you don't actually write a check for it. You already paid for the equipment years ago. So to get to your real cash flow, you have to add that non-cash expense back to your net income.
So that $7 billion in cash from operations tells us their profitability is high quality. It's translating into real cash.
It's massive cash generation, exactly. And then you see where that cash goes. McDonald spent $3.2 billion on investing in new property and equipment.
That's a clear sign of growth, reinvesting back into the business.
Yep. And then the last piece, financing. They spent $3.8 billion.
What's that?
That's the mature company returning value to its shareholders. They're paying out dividends and buying back stock or repaying loans. So the story here is just rock solid. Profit is turning into a ton of cash, and that cash is being strategically used to both grow the business and reward investors. The three statements together paint a really clear picture. And, these external financial statements, they aren't just for Wall Street analysts. They provide managers with the framework to create their own internal reports, what we call managerial accounting, to tell the story of their own department or their own project. It's the same logic, just applied internally.
So the big takeaway for you, the learner, is that when you look at these reports, you're not just reading numbers. You're reading a strategic document. They're reliable, they're structured, and they're designed for making really critical decisions about risk, about return, and about how to use your resources.
Right. They force a kind of accountability. And to leave you with a provocative thought that kind of challenges that, our entire discussion today is built on one core idea: the going concern assumption.
The idea that the company will just keep operating forever, more or less.
Exactly. And that assumption is what lets us report assets at what we paid for them, their historical cost, instead of, say, what we could sell them for tomorrow.
Because if the business is going to be around for 30 years, the historical cost is more relevant than some fire sale price.
Precisely. But what if you, as a manager, had to throw out that assumption? What if you had to prepare financial statements assuming immediate liquidation? How would that change the value of every single asset on your balance sheet?
Well, that wrecked delivery truck we talked about, even if you legally own it, its value would instantly go to basically zero. Scrap metal.
The second it fails that test of providing probable future economic benefit, its value on the balance sheet just collapses down to a hard, cold reality.
It would force you to ask some really tough questions about the true usefulness of every single thing you control.
That's the power of the framework.
A fantastic deep dive into the strategic heart of accounting. Thank you so much for guiding us through that unbreakable logic.
My pleasure.
And to you, the learner, keep practicing this way of thinking. Every business headline you read is rooted in the structure we talked about today. We'll see you next time on the Deep Dive.